can join in the conversation. Certainly plenty to talk about today. We're on Twitter. Just use the hashtag on the bottom of your screen or email us yourmoney@skynews.com.au. We'll try and get to all the questions that you do send through us. Let's get straight into it. Julia Lee, fear had been building up over the weekend on what was a disastrous non-farms and reaction on Wall Street. And in the end, it sort of came true on our own market.
James, the market knew it was in for a bad day, and that's after the US markets dropped 2.2% on Friday on the back of that dismal non-farm payrolls number coming in at just 69,000 compared to a market expectation of 150,000. That was on top of some weak economic data coming out from all around the world. We had been watching the manufacturing numbers, and we saw soft reads out of Europe, out of China and out of the US. So altogether, just adding to the disappointment in the market. Today was important because we did break some key technical levels over the last 30 days. The short-term target has been 4,026 points. We actually fell through that on the open, and of course the 4,000 point psychological mark, we fell through that, and we have a near-term target at 3,973 points. It was red all across the board. If we have a look at the top 20 stocks, only 3 managed to gain ground. The top 50 stocks, only 4 managed to gain ground. And the top 100 stocks, we only saw 9 stocks gaining ground. So it was a bloodbath on the market today. The worst areas, not surprisingly, the energy sector down by 3.3%, driven by that oil price, which plummeted 3.8% on Friday, and the materials and the discretionary space down by 2 3/4%. The safe havens, not surprisingly, those high-yielding areas. Telstra was a big winner there. And the gold stocks finally bouncing back on expectations with more quantitative easing. So we did see those gold stocks doing extremely well. But in the end, our market down by 1.9%, finishing on the lows of the session with $4.2 billion being traded.
So much. We spoke about it throughout the day, that 4,000 level, more than anything, a psychological level. But closing below it, closing on the lows, I mean, where do we start looking towards in terms of support levels?
I mean, so many people are calling this market as very good value at the moment, but that entirely misses the point of what's driving the market. This isn't a market that's being driven by cyclical events, the fact that the market's looking cheap versus expensive, and it never has been. It's always been about event risk. So what's going to turn around market sentiment in the medium term are the policy responses, and what the market hoping for is a circuit breaker. In the past, we've seen that to be things like QE1, QE2 or QE3 or Operation Twist, as we know it in the US. Out of the UK, we've seen quantitative easing. Out of Japan, quantitative easing. And out of the Eurozone, we've seen the LTRO 1 and 2 operations as well. And I guess a big problem with this is that we are seeing a shorter effect in these circuit breakers for the market. The LTO, the long-term refinancing operation that we saw at the start of the year, really helped stocks to be off on a good footing for 2012, but already we've seen the benefits of that disappearing and the market refocusing in on the core problems. And really what we've seen by central banks around the world and governments around the world is that they're throwing a lot of liquidity in the market to tackle what's essentially a solvency issue. So coming to what's the core problem at the moment is Europe and the solvency problem there. And I guess one of the solutions, part of the solution is forgiving some of the debt. And the other part of the solution is the currency mechanism, which we don't have. And we don't really have a solution because it is a shared currency. So returning back to the core of the problem, I guess in the past we've seen a lot of money being thrown about. The problem here is now that those circuit breakers are having a much shorter and shorter effect.
So made reference to the anticipation of some sort of central bank stimulus that we know very much flows into commodities and of course the likes of gold.
Well, recently we haven't seen the gold price really reacting too much from that huge fall that we've seen in equity markets. In May, we saw the biggest drop-off since May 2010, and yet gold was an underperformer as well. So if we have a look at what's driving gold and the turning point for gold, it was obviously those non-farm payroll numbers coming out of the US on Friday and increased expectations around quantitative easing. So it's the fact that you can't print gold, the fact that rates around the world in a lot of the major economies in the US, Japan, in the UK and in Europe are seeing real rates which are negative, and so we've seen continued support for gold. The big question for traders and investors is, do they get exposure to gold through things like ETFs, or do they buy physical gold, or do they actually go for gold stocks? Because the performance has been very different depending on how you access gold. If we have a look at the gold ETF in Australian dollar terms, in 2012 it's been a pretty good investment so far, up by 9.3%, compared to gold in US dollars traded in New York, which is up by 3.5% for the year. And then you have a look at the gold sector, and as David mentioned, it's been absolutely it's been a very poor performer. It's been down by around about 13%. So altogether, those gold stocks have had a terrible 2012, even though the gold ETF and gold prices have been doing relatively well. Now, gold's been a very strong performer, and I guess it is time for a bit of a mean reversion. As the gold price does increase, it is those marginal producers which will benefit the most, and that's why we see some of those smaller and mid-sized gold stocks performing well when we do start to see the price moving up. And we certainly started to see that today. We saw Alaska Gold are doing extremely well, gaining around about 10%, and we also saw Perseus Mining doing well, gaining about 7.7%. So altogether, those gold miners underperformers, but we are starting to see a bit of mean reversion there.
Great.